You look at the stock market, right? And it's just this constant roller coaster. Ups and downs.
Right.
One day things are soaring, the next maybe dipping like an investor's stomach feels sometimes.
Yeah, definitely seen that movie.
And you see different stocks doing wildly different things. Some seem to track the market pretty closely. Others amplify its every little wobble, while some, well, they barely seem to budge no matter what's going on.
Right. Huge variation.
How do we even begin to put a number on that? That kind of relative movement.
Yeah.
How do you sort the thrill rides from the gentle cruises in your portfolio, especially when you're thinking about the market's influence?
That's a great question. And it's exactly the puzzle we're tackling in this deep dive today.
Yeah.
Yeah, we're cracking open a really core, fundamental concept in finance. It's called beta.
Beta.
Exactly. We're going to use the sources you've given us to really drill down, understand what beta is, how it specifically helps measure how individual stocks move with the overall market.
Right. The with part is key.
It is. And what that relative sensitivity actually means for the risk profile of your investments, particularly, within a broader portfolio.
Okay, so this deep dive is focused specifically on beta. I think I've heard it called market beta or beta coefficient.
That's right. Those are other names for it. It's basically a statistic, a quantitative tool used in finance. The goal is to give us a handle on a stock's expected price response, its volatility, but always in relation to a broader market benchmark, usually a major index like the S&P 500.
Okay. Benchmark is important.
Crucial. And we're going to cover all the essential angles, drawing just from the sources we have. We'll start with a clear definition, what is beta? Then how to properly interpret the specific values you see quoted. What does a high number mean versus a low one?
Yeah, what do the numbers actually tell you?
Exactly. We'll look at the math behind it, briefly how it's calculated, and importantly, where you can practically find these beta values for stocks you might be interested in. Crucially, we'll explore beta's big role in assessing systematic risk and thinking about potential returns, especially within a well-diversified portfolio.
Right.
But, and this is really important, no single metric tells the whole story. So we're also going to dig pretty deep into beta's limitations because it is far from perfect.
Okay. Good to know the caveats.
Definitely. And we'll explore some more sophisticated ways finance pros approach risk assessment that go beyond just simple beta.
So our mission today, it sounds like, is pretty specific. For you, the listener, take these sources, pull out the absolute core knowledge about beta, and make sure you walk away with a really clear, actionable understanding of this fundamental piece of the investing puzzle. We want you to know what it is, how it's used.
And where its usefulness ends.
Exactly. Just as important.
Yeah.
So consider yourself strapped in. Let's dive in.
Let's do it.
All right, let's kick things off right at the beginning. What exactly is beta? When someone throws that term around, says a stock has a high beta or a low beta, what are they fundamentally talking about?
Okay, so at its most basic level, beta is a statistical measure. It quantifies the expected movement, the expected change in an individual stock's price in proportion to the movements of the stock market as a whole.
Proportion.
Okay. Think of it like a sensitivity index. How sensitive is this one stock to the market's overall swings?
Sensitivity. Okay. So it's not just about how much a stock price bounces around on its own, its own inherent bumpiness.
Yeah.
It's how much it swings because the market is swinging. Is that the idea?
Precisely. That is the critical distinction. It does measure volatility, yes, but specifically volatility relative to the market benchmark being used.
Okay. Relative volatility.
Right. As the sources confirm, it's also known as market beta or the beta coefficient. And it's a really cornerstone concept, particularly within something called the capital asset pricing model, or CAPM.
CAPM. I've definitely heard that acronym. That's a big model for thinking about risk and expected return, right?
It is. The capital asset pricing model, it's a widely used framework in finance. It tries to determine the theoretically appropriate required rate of return for an asset if that asset is added to an already well-diversified portfolio. The basic idea is that the expected return equals the risk-free rate plus a risk premium.
Okay.
And that risk premium is calculated using beta. So within CAPM, beta is the measure of the systematic risk an asset contributes to that diversified portfolio.
Okay, so beta is a measure of risk. Got it. But as we know, not all risk is the same. There's risk that's like unique to a specific company, and then there's risk that seems to affect the whole market. Which kind does beta capture?
This is absolutely essential to grasp. It's really beta's primary job description, you could say.
Okay.
Beta specifically measures systematic risk. The sources also call this market risk, or sometimes non-diversifiable risk.
Non-diversifiable, meaning you can't get rid of it just by owning lots of different stocks.
Exactly. This is the portion of an investment's total risk that's inherent in the broader market or the economy itself. It can't be eliminated or even significantly reduced just by diversifying within that market.
So things like big changes in interest rates, inflation worries, geopolitical stuff, recessions, factors that kind of hit almost all stocks to some degree.
Precisely. Beta is designed to capture how much a particular stock is susceptible to those kinds of broad market-wide movements. And here's where it gets really focused. Crucially, the sources make it very, very clear. Beta does not measure idiosyncratic risk.
Idiosyncratic risk. Okay, that's the company-specific stuff we mentioned, like a company's management team making some bad calls, maybe a sudden strike by workers, a product recall, or even something really localized like a factory fire.
That's exactly right. It's also called unsystematic risk or diversifiable risk. This is the risk that's unique to a specific company or maybe an industry or an asset. The whole point of diversification in investing, the fundamental principle, is that by holding a wide variety of different assets, these individual company-specific risks tend to cancel each other out within a portfolio.
Okay, yeah. One company's bad news might be offset by another one's good news, or just unrelated news.
Exactly. They're not perfectly correlated.
Yeah.
So beta is only concerned with the risk that remains even after you've diversified away as much of that company-specific risk as you possibly can. It's the risk that comes from the market itself moving up or down.
That really paints a much clearer picture. So if I just hold one stock, its total risk is high because it's got all its own unique issues, plus the market risk baked in.
Great.
But if I hold, say, 100 different stocks across various sectors, those company-specific risks kind of wash out. They become less important for the whole portfolio.
They average out.
And the main risk left driving my portfolio's swings is how sensitive the whole thing is to the market. And beta measures that remaining market sensitivity.
You got it. It's quantifying that unavoidable exposure to broad market swings. And the sources even link beta directly to the concept of a hedge ratio. Beta represents the hedge ratio of an investment with respect to the stock market.
A hedge ratio.
Yeah.
Okay, how does that connect? What does that mean practically?
Well, the Wikipedia source gives a really good illustrative example. Imagine you own $1,000 worth of a stock, and this stock has a beta of 2.0.
Okay, beta of 2, high sensitivity.
Right. This beta implies that for every 1% the market moves, this stock is expected to move 2% on average in the same direction.
Right.
Now, if your goal was to hedge out only the market risk from this position, basically, you want to isolate the stock's performance that's not related to market swings. The hedge ratio concept suggests what you do.
Okay.
You would short $2,000 worth of the overall market index, maybe an S&P 500 tracking ETF, for instance.
Okay, wait. Shorting $2,000 of the market against my $1,000 long position in the beta 2.0 stock. Why twice the amount?
Because the stock is twice as sensitive to the market as the market index itself, which has a beta of 1. Think about it. If the market goes up by 1%, your $1,000 stock position is expected to gain about 2%.
Right.
That's $20.
Right.
Meanwhile, your $2,000 short position on the market index is expected to lose about 1% on that $2,000, which is also $20.
They offset.
Theoretically, yes.
Yeah.
Those market-driven movements offset each other.
Yeah.
And the same if the market drops. If the market drops 1%, your stock might lose 2%, a $20 loss. But your short market position would gain 1% on the $2,000, a $20 gain.
Wow. Okay, that concrete example really drives home how beta is a direct measure of relative sensitivity. It's literally the number you'd use if you wanted to build a position that cancels out the market's influence, leaving you just exposed to the stock's own unique factors, its idiosyncratic performance.
It's exactly that. It measures the contribution of an individual investment to the risk of the market portfolio that was not reduced by diversification. It isolates that systematic component of risk.
Okay, so beta tells us how much a stock is expected to move when the market moves. Now, let's talk about interpreting the actual beta numbers themselves. What does a beta of, say, 1.0 or 2.0 or maybe 0.5 or even a negative number, what does that actually tell an investor?
This is absolutely key to using beta effectively. The baseline, the starting point for interpreting beta, is always the market benchmark itself. By definition, a broad market index like the S&P 500 has a beta of exactly 1.0.
Okay, the market is beta 1.0. That's our anchor point. Simple enough.
So if an individual stock has a beta very close to 1.0, it suggests its price activity, historically at least, correlates closely with the market.
Wow.
On average, when the market index moves up by 1%, that stock is expected to move up by roughly 1%.
And down 1% when the market's down 1%.
Roughly, yes. Adding this kind of stock to a portfolio doesn't really change the portfolio's overall systematic risk level much compared to just holding the market index itself.
Okay, so beta 1.0 means it pretty much rides shotgun with the market. Makes sense. What about stocks with a beta greater than 1.0? Are these the ones that, like, amplify the market's moves?
Generally, yes. A beta greater than 1.0 indicates a stock that is expected to be more volatile than the market. Its price is expected to move more than dollar for dollar or percentage for percentage with market returns, on average.
Right.
The sources offer a few ways to think about this. A stock with a beta of 1.75, for example, might have an expected return that's 175% of the market's return in a given period. So if the market is up 1%, this stock might be up 1.75%.
Okay.
A beta of 2.0, theoretically, suggests the stock is twice as volatile as the market benchmark. A beta of 1.30 implies it's expected to be about 30% more volatile than the market.
So just to be clear, if the market goes up 1%, a stock with beta 2.0 might gain 2%. But if the market drops 1%, that same stock might lose 2%.
That's the expectation. Based on the historical relationship, yes. Higher beta means greater potential for those outsized gains when the market's rising.
The fun part.
But it also means greater risk of amplified losses when the market's falling. These are generally the higher risk, potentially higher reward stocks, purely in terms of market sensitivity.
Got it. And the opposite. What about beta less than 1.0, but still greater than 0?
Right. A beta less than 1.0, but still positive, indicates a stock expected to be less volatile than the market. Its price movements are typically less extreme than the market's overall swings. These stocks tend to move less than 1-to-1 with market returns.
Okay.
For example, a stock with a beta of 0.45 might only see its price change by about 0.45% on average when the market moves 1%. A beta of 0.79 suggests it's expected to be, 21% less volatile than the market benchmark?
So these are kind of the more stable, maybe defensive stocks. If the market drops 1%, a stock with beta 0.5 might only drop, say, 0.5%.
That's generally the behavior you'd expect. These stocks are less likely to deliver massive gains just from market rallies alone, but they tend to offer more stability and potentially some downside protection during market declines. They add less systematic risk to a portfolio than a beta 1.0 stock would.
Okay. What about a beta of exactly 0? Does that happen?
A beta of 0 means the stock's price movements are expected to be completely uncorrelated with the market's movements. When the market moves, up or down, this stock's price isn't expected to change because of that market movement.
Interesting.
Yeah. The sources mention this is seen as a positive signal for investors looking for assets that offer diversification specifically against market downturns because their performance isn't tied to the market's fate. Now, it's pretty rare for typical stocks to have a beta right at 0.
Right.
But certain other assets might exhibit near 0 beta relative to the stock market.
Okay, that sounds fascinating for diversification purposes. And then there's the really unusual case, right? A beta less than 0. A negative beta.
Yes, a negative beta. This means the stock or asset is expected to be negatively correlated with the market. It actually tends to move in the opposite direction.
Opposite. So if the market goes up, a negative beta asset is expected to go down.
Exactly, and vice versa. The sources give examples like a beta of 0.2, which might imply an expected return of negative 2% when the market is up 10%. Or a beta of a negative 1.0 would suggest a perfectly inverse relationship, moving 1-to-1 but in the opposite direction of the market.
So hang on. If the market crashes, a stock or asset with a negative beta might actually go up.
In theory, yes. That's the implication.
Indeed.
Assets with significant negative beta can serve as powerful hedging instruments against market risk. They zig when the market zags.
Wow.
However, and the sources really emphasize this, it's exceptionally rare to find a common stock with a reliably, significantly negative beta over any extended period.
Okay, so don't expect your average stock to do that.
No. It's more often seen, perhaps slightly, in assets like gold sometimes, which can have a negative or 0 beta relative to stocks depending on the period. Or it's seen in specific financial instruments designed to move inversely to the market, like put options or inverse ETFs.
Okay. Things built specifically for that purpose. Got it. So beta really gives you this single number that acts like a dial, indicating how much a stock's price is turned up or down relative to the overall market volume. High beta means it's loud when the market's loud. Low beta means it's much quieter.
That's a pretty good way to visualize it, yeah. And understanding that relative sensitivity is especially crucial when you start thinking about building a portfolio of multiple assets.
Which leads us perfectly into our next point, beta and diversification. We've touched on this distinction between systematic and idiosyncratic risk, but why is beta considered the key risk measure specifically for portfolios? What's the connection there?
This is really fundamental in modern portfolio theory. As we discussed, beta measures the contribution of an individual investment to the risk of the market portfolio specifically, the risk that cannot be diversified away just by holding a mix of different market assets.
Okay, so it's focused purely on the risk that diversification can't eliminate, by definition, within that market.
Exactly. And the sources make a really crucial point here. Beta doesn't measure the total risk when an investment is held in isolation, as a standalone asset. If you just buy one single stock, its total risk is better measured by its standard deviation of returns.
Standard deviation, right? That's just how much the stock's price fluctuates overall, up or down, all its jiggles combined.
Yes, exactly. It measures the total variability or dispersion of its returns around its average return. But the theory, which is strongly supported by the sources and underpinning things like capital market theory, is that in a well-diversified portfolio, the unique company-specific risks, those idiosyncratic risks of the individual holdings, are largely uncorrelated with each other, and therefore they tend to cancel each other out across the portfolio.
So the bad news for one company is often offset by good news or just totally unrelated movement in the others you hold.
Precisely. As one of the Reddit discussion sources puts it quite nicely, in a well-diversified portfolio, that idiosyncratic risk is diversified away. It largely disappears at the portfolio level, leaving only market risk, the systematic risk captured by beta as the primary relevant risk factor affecting the portfolio's overall volatility.
Ah, okay. So for someone holding, say, an S&P 500 index fund or maybe a similarly broad portfolio they've built themselves, the most relevant measure of their portfolio's risk exposure to the market isn't necessarily the average standard deviation of all the individual stocks inside it,
Right.
but rather its overall portfolio beta.
That is the central argument. For a well-diversified investor, beta is considered the best measure of risk, because by diversifying, they've effectively reduced the total risk. The portfolio's standard deviation will be lower than the average stocks, down to the point where only the systematic risk truly remains as the dominant driver of its fluctuations. The standard deviation of the portfolio itself might still be significant, absolutely. But the source of that remaining risk, according to the theory, is the portfolio's sensitivity to broad market movements. And that sensitivity is measured by its beta.
So beta is the risk metric that matters most after you've done the hard work of diversifying away those company-specific risks. It tells you how bumpy the ride of your whole diversified portfolio is likely to be when the market itself gets choppy.
That's the core idea, yes. It quantifies that unavoidable market exposure that sticks around even in a highly diversified portfolio.
Okay, so beta is clearly useful, especially for investors who are well-diversified. But how do we actually arrive at that number? Is it something you calculate yourself, or is there like a standard formula?
You absolutely can calculate it yourself, and understanding the method is pretty key to understanding what the number itself represents. The fundamental mathematical definition, which you'll find across the sources, is beta equals the covariance of the stock's return and the market's return, R and M, divided by the variance of the market's return.
Okay, covariance and variance again. Let's unpack what those mean specifically in this formula. Not everyone remembers their stats class.
Fair enough. So in this context, covariance, R-A-R-E-M-M, measures the degree to which the returns of the individual stock move together with the returns of the market.
Right.
Do they generally rise when the other rises, fall when the other falls? A high positive covariance means they tend to move strongly in the same direction.
Okay, how much they move together.
Right. And variance measures how much the market's returns fluctuate around their own average. It's basically a measure of the market's own volatility, its own jumpiness.
Got it.
So beta is essentially the measure of how the stock and market returns move together, the covariance. But it's scaled, it's divided by how much the market moves by itself, the variance. It tells you, for a given amount of market movement, how much movement do we tend to see in the stock, specifically relating to that market movement.
That explanation helps clarify the relationship a lot. It's like, how much bang for the market's buck do you get in the stocks movement? And the sources also bring in the concept of linear regression, right?
Yes, that's actually how beta is typically estimated using historical data. If you had to plot the stock's historical returns on a graph against the market's historical returns for the same periods, like daily or weekly returns, beta is essentially the slope of the line of best fit that you could draw through those scattered data points. The statistical model looks something like this. Stock return equals alpha plus beta market return plus some error term.
Okay, so the slope of that line tells you how much the stock's return is expected to change for every 1 unit change in the market's return.
Exactly. That slope is your estimated beta. And you notice this regression equation also introduces alpha.
Right, alpha.
Alpha represents the portion of the stock's return that is theoretically independent of the market's movement. It's the part not explained by beta in this simple model.
So alpha is kind of the leftover performance after you account for the market risk exposure, maybe due to company specifics or skill.
Loosely speaking, yes. It's often interpreted as the component attributed to company-specific factors, or maybe manager skill if it's a fund. Beta also relates directly to two other key stats, correlation and volatility. The sources give the formula. Correlation, standard deviation, standard deviation.
Okay, break that one down. Beta is the correlation between the stock and the market, multiplied by the stock's total volatility, divided by the market's total volatility.
Correct. This formula is really insightful because it shows how beta connects the stock's overall volatility, its standard deviation, and the market's overall volatility. But crucially, it scales that relationship with the correlation between the two. And the sources make a really clarifying point here. Idiosyncratic risk is tied to the stock's total volatility, but it's different from beta. They use a great example. Imagine the simple coin toss bet.
Okay, 50-50 heads or tails.
Right. That bet might have huge volatility, right? High standard deviation. You could win or lose big. But if the outcome of that coin toss is completely unrelated to what the stock market does on any given day,
which it obviously is.
Right. Then its correlation with the market would be zero. And if the correlation is zero, then its beta, using that formula, must also be zero.
Ah, that's an excellent example. So you can have high total risk, high volatility, high standard deviation, but absolutely zero systematic market risk, zero beta. If the source of that risk is completely uncorrelated with the market, really clarifies the distinction.
It does. Now, for the practical calculation steps using historic data, the sources typically list these. First, you need to get a time series of historical price data for both the stock and your chosen market index over a certain period, maybe 1 year, 3 years, 5 years.
Okay.
Second, you calculate the historical returns for both the stock and the market for each period within that time frame. Daily, weekly, or monthly returns are common choices.
Right, the percentage changes.
Exactly. Third, you compute the covariance between the stock's series of returns and the market series of returns over that whole period.
Okay.
Fourth, you compute the variance of just the market's returns over that same period. And finally, step 5. You divide the covariance, step 3, by the market variance, step 4, to get your historical beta estimate.
That actually sounds like something you could definitely set up in a spreadsheet program like Excel.
You absolutely can. The CFI source explicitly mentions using the SLOPP function in Excel. That function basically performs the linear regression we talked about, and the output it gives you is the beta, the slope of that best fit line.
Huh. Okay. But for most investors, I assume it's easier to just look it up somewhere.
Oh, for sure. Beta values are very widely calculated and published. You don't need to calculate it yourself unless you really want to. The sources point to common places. Financial news websites like Yahoo Finance, Morningstar, Reuters.
Yeah, I've seen it on those.
Professional financial data platforms like Bloomberg Terminals or LSEG Data and Analytics, which used to be Refinitiv, have it, of course. And most online brokerage platforms will display a stock's beta right there on the quote page.
Okay, so the math and the steps are how the number gets derived behind the scenes, but for everyday use, you can usually just find a quoted beta pretty easily.
Exactly. It's readily available. It is important to note, though, as we hinted earlier, that the quoted beta you find can sometimes vary a little bit, depending on the source.
Oh, why is that?
Because different providers might use slightly different methodologies. They might use different historical time periods, like a 1-year beta versus a 5-year beta. They might use different return frequencies, daily returns versus weekly returns, or they might even use slightly different market benchmarks. So the number might not be exactly the same everywhere.
That makes sense. Beta is based on history, and how you measure that history matters. The past isn't always, perfectly consistent.
Right. And that choice of period and benchmark is actually one of the calculation nuances we'll definitely need to dig into more when we discuss the limitations of beta later on.
Okay, looking forward to that. So we know what beta is, we know how to interpret the numbers roughly, and we know how it's calculated or where to find it. Let's talk about the practical implications now by looking at the typical characteristics of high beta versus low beta stocks. What kind of companies usually fall into each bucket?
Right. So stocks with a high beta, generally considered anything significantly greater than 1.0, are often associated with more growth-oriented companies. These tend to be businesses in more dynamic sectors, maybe earlier in their corporate life cycle, often focusing heavily on expansion and future potential rather than, say, current profitability or paying big dividends.
Like tech companies, maybe, or companies in newer emerging industries.
Often, yes. They can certainly include technology companies, consumer discretionary stocks, things people buy when they feel wealthy, or other sectors that tend to be more sensitive to the overall economic cycle. The sources mention Tesla as a kind of classic example of high beta stock. Its 5-year beta was quoted around 2.43 as of May 2025 in one source.
Wow, 2.43, that's high.
It is. It means its stock price was expected to move, on average, nearly 2.5 times as much as the overall market. These stocks inherently carry higher systematic risk exposure, but they also offer the potential for those outsized returns when the market is in a strong uptrend, the bull market.
Okay. And the low beta stocks, what do they typically look like?
These are stocks with a beta typically less than 1.0, but usually still positive. They're often referred to as defensive stocks. These tend to be companies whose products or services are in relatively constant demand, more or less regardless of the overall state of the economy.
So things like utilities, healthcare, consumer staples stuff people need to buy even during a recession, like toothpaste and power.
Exactly. Companies providing essentials like electricity, food, beverages, basic household goods, or necessary healthcare services. The sources use Procter & Gamble, a major consumer staples company, as a prime example. One source noted its 5-year beta was around 0.41 in May 2025.
0.41, so less than half the market sensitivity.
Right. It implies its stock price was expected to be much less sensitive to broad market movements compared to the overall index. These stocks are generally associated with lower systematic risk and tend to offer more stability, often providing consistent dividends, which can be particularly valued by investors during economic downturns or periods of market uncertainty.
So it sounds like high beta is for the potential high-octane ride, closely tied to market sentiment, while low beta is more for stability and maybe resilience when the market inevitably gets rough.
That's the general pattern, yes. And one of the sources, the Reeves Asset Management piece, provides some really powerful historical data that illustrates this distinction quite beautifully. They did a comparison.
Yeah. What did they compare?
They looked at the performance of the stock market sectors with the lowest average betas, specifically utilities, consumer staples, and healthcare, against the sectors with the highest average betas, which were information technology, financials, and industrials. And they looked at this over a very long period, 32 years.
Okay, 32 years. What did that comparison show? Was there a huge difference in returns?
Interestingly, over the entire 32-year period, the difference in the final annualized total returns wasn't actually that huge. The low beta sectors averaged 10.8% per year,
Pretty good.
while the high beta sectors averaged 11.2% per year. So fairly similar long-term results. However, they achieved these similar long-term returns with vastly different levels of market risk exposure along the way. The low beta group had an average beta of just 0.61 over that period. The high beta group, on the other hand, had an average beta of 1.23.
Whoa. So you could have potentially gotten roughly similar end results over 3 decades, but with a significantly smoother, less volatile journey by focusing on those lower beta sectors.
That's exactly what their data suggests for that specific period. And the contrast became dramatically, starkly clear when they zoomed in on the performance specifically during the brutal bear market period from 2000 to 2009.
The decade, including the dot-com bust and the financial crisis. Right.
A really tough decade for markets. Over those 10 years, the cumulative total return for the high beta sectors was a staggering loss of 65.9%.
Ouch. Minus 66%?
Yeah. In stark contrast, the low beta sectors saw a much, much milder decline. Their cumulative loss over that same decade was only 2.3%.
Wow. losing nearly two-thirds of your value versus losing just over 2% in a major decade-long downturn. That really highlights the practical impact of beta in terms of downside protection, doesn't it?
Yeah. It absolutely does. It vividly demonstrates that while high beta can offer those amplified gains in bull markets, it absolutely delivers amplified losses in bear markets. Low beta, conversely, tends to limit the upside participation in big rallies, but provides potentially significant protection during major drawdowns. That historical data from Reeves makes a strong case that you can achieve competitive long-term returns without necessarily taking on the highest levels of market volatility.
Yeah.
And Investopedia also confirms this general pattern. Higher beta stocks tend to outperform when the market is rising in bull markets, while lower beta stocks typically fare better during economic contractions or recessions.
So it seems an investor's comfort level with beta might really depend on their individual risk tolerance, but also maybe their outlook for the overall market cycle.
Potentially, yes. Although using beta for active market timing, like trying to switch between high and low beta based on forecasts, what some call beta rotation strategies, requires successfully predicting market movements, which is, as you know, notoriously difficult to do consistently.
Yeah, timing the market is tough.
Very. And the sources also suggest, maybe unsurprisingly, that beta is generally considered more reliable for assessing risk in the shorter term compared to predicting long-term behavior.
Okay. We focused a lot on individual stocks, but most investors don't just own one stock. They build portfolios. How does this concept of beta extend to a whole collection of different securities?
Right, that's where the idea of portfolio beta comes in. It's essentially a measure of the overall systematic risk of your entire portfolio investments taken together relative to your chosen market benchmark. It aims to give you a single number representing the aggregate market sensitivity of all your combined holdings.
Okay, so it's not just like the simple average of the betas of all the stocks in the portfolio?
No, not quite. It's a weighted average. The portfolio beta is calculated as the sum of each individual security's beta multiplied by its specific weight within the portfolio.
Weighted by how much money you have in each one.
Exactly. Weighted by the proportion that each security's market value represents of the total portfolio value. The sources describe beta as being a linear operator in this sense, meaning you can legitimately add and average betas as long as they are weighted appropriately by their position size.
Okay.
So if your portfolio consists of, say, asset A, which makes up 80% of the total value and has a beta of B, and asset B, which makes up the other 20% of the total value and has a beta of B, the portfolio of beta is calculated simply as 0.80 times beta plus 0.20 times beta area.
That seems pretty straightforward, actually. You just need to figure out the percentage each stock or asset accounts for in your total portfolio value, multiply that percentage by that stock's individual beta, and then just add up all those results for every holding.
That's exactly it. Wall Street Prep provides a very clear step-by-step example of this calculation in practice. Let's walk through it. Imagine you have a portfolio valued at $2 million, and it holds these 5 specific stocks with these weights and betas, as quoted in the source, potentially from around May 2025.
Okay, let's hear it.
First, NVIDIA. You hold $400,000 worth as 20% of the $2 million portfolio. Its beta is given as 1.75. Second, Amazon, AMZN. You hold $200,000 worth, which is 10% of the portfolio. Its beta is 1.26. Third, Alphabet, GOGL. You hold $800,000 worth, a big chunk, 40% of the portfolio. Its beta is 1.05. Fourth, Microsoft, MSFT. You hold $200,000 worth, another 10% of the portfolio. Its beta is 2.91. And fifth, Apple, AAPL. You hold $400,000 worth, the remaining 20% of the portfolio. Its beta is 1.29.
Okay, got the holdings, weights, and individual betas. Walk me through the calculation for the overall portfolio beta.
Okay, first you calculate the weighted beta contribution for each position. For NVDA, it's 20%, or 0.20 times its beta, 1.26. Let's round that to 0.13 for simplicity. For AMZL, it's 40%, 0.4 down times 1.42, which equals 1.10, times 0.1, which equals 1.91. Let's round that to 0.09. And for AAPO, it's 20%, 0.20 times 1.29, which equals 0.258. Let's round that to 0.26.
Okay, so those are the individual weighted contributions, 0.35, 0.13, 0.42, 0.09, and 0.26, and then you just sum those up.
Exactly. Portfolio beta equals 0.35 plus 0.13 plus 0.42 plus 0.09 plus 0.26. If you add those together.
Let's see. 0.35 plus 0.13 is 0.48, plus 0.42 is 0.90, plus 0.09 is 0.99, plus 0.26 is 1.25.
Precisely. The total portfolio beta for this specific example portfolio is 1.25.
All right, a portfolio beta of 1.25. How do we interpret that number for this particular $2 million portfolio? What does it tell us?
Well, just like interpreting the beta for an individual stock, a portfolio beta of 1.25 means that this specific collection of investments, when viewed as a whole, is expected to be more volatile than the overall market benchmark, specifically about 25% more volatile on average.
Okay.
The Wall Street Prep source notes that this implies the portfolio carries substantial systematic risk relative to the overall market. It's likely to experience larger swings in value, both up and down, than the market index, especially if there's a significant market downturn.
That makes perfect sense when you look at the holdings. Given the pretty significant weightings in those high beta tech stocks like Nvidia and Apple in that example, it seems logical that the overall portfolio beta gets pulled above 1.0.
Exactly. It's a single summary number that effectively captures the aggregate market risk exposure of your entire diversified set of holdings based on the individual betas and their weights. Now, the sources also make an important technical distinction when we're talking about beta in the context of portfolios versus, say, analyzing businesses for valuation purposes.
What's that?
The beta you typically see quoted for individual stocks, and the portfolio beta we just calculated, is usually what's called levered beta.
Levered beta. Okay, what's the alternative? Is there an unlevered beta?
Exactly. There is unlevered beta. This is a more technical concept often used in corporate finance, especially when people are doing things like company valuations, using discounted cash flow, DCF models, or maybe comparable company analysis.
Okay, tell me more about this unlevered beta. What's different about it?
Unlevered beta, which is also sometimes called asset beta, is a measure of risk that attempts to strip out, to remove, the impact of a company's debt from its beta calculation. It tries to represent the pure underlying business risk of the company's operations and assets, imagining for a moment what the risk would look like if the company had no debt at all in its capital structure.
Okay. So levered beta, which is also called equity beta or sometimes just stock beta, that includes both the risk of the underlying business operations and the additional financial risk that gets introduced when a company takes on debt, the leverage.
Precisely. The beta you find on Yahoo Finance or Bloomberg for a publicly traded stock is almost always the levered beta. It compares the volatility of the company's stock price, which is definitely affected by how much debt the company carries to the overall market.
Right.
Unlevered beta, on the other hand, allows analysts to compare the inherent operational or business risk of different companies more directly, even if those companies have vastly different levels of debt financing. It puts them on a more level playing field for comparing just the business risk.
That makes sense, because debt makes a company's earnings and therefore ultimately its stock price more sensitive to changes in revenue or the overall economy, right? More debt means higher fixed interest payments, which tends to magnify both profits when things are good, but also magnify losses when things turn bad, especially for the equity holders.
That's exactly right. Debt adds a layer of financial risk on top of whatever the company's core business risk happens to be. By theoretically removing the effect of this financial leverage, unlevered beta aims to give a cleaner picture of just the risk associated with the company's core assets and its operations themselves.
So unlevered beta would be useful for analysts comparing, say, two retail companies. They might be in the same basic industry, but maybe one has loaded up on debt and the other has very little. Unlevering their betas helps compare their underlying business risk.
Yes, that's a primary use case, particularly in valuation work. An analyst might calculate the unlevered beta for a group of similar, comparable companies in an industry to get a sense of the typical business risk level for that sector. Then, they can take that average unlevered beta and re-lever it using the specific debt-to-equity ratio of the target company they are trying to value.
Re-lever it. Add the debt effect back in.
Exactly. This process helps estimate the appropriate cost of equity for that specific target company based on both its underlying business risk from the comparable companies and its unique capital structure, its own debt level. The sources note that analysts often use the target company's current capital structure for this relevering, but sometimes they might use a target or projected capital structure if there's a clear plan for the company to significantly change its debt levels in the future.
Okay, that's quite a sophisticated process for valuation. And the sources provide the actual formulas for converting between levered and unlevered beta.
They do. The CFI source gives the standard formulas. To get unlevered beta, levered beta 1 plus 1 tax rate, debt equity. And to go the other way, levered beta 1 plus 1 tax rate, debt equity.
Okay, so you need the stock's quoted levered beta, you need the company's corporate tax rate because interest payments on debt are usually tax deductible, right?
Okay.
And you need its current debt to equity ratio.
Right. That one tax rate factor in the formula accounts for what's called the debt tax shield effect. Because interest is tax-deductible, debt has a slightly lower effective cost, which influences the company's overall cost of capital and indirectly affects the relationship between levered and unlevered beta.
Uh,
So while the portfolio beta you calculate for your own investments is typically based on the standard levered betas you find,
right.
understanding this concept of unlevered beta is really crucial if you're diving deeper into analyzing business risk itself or doing corporate finance work like valuation.
It really does highlight the need to understand what kind of beta you're looking at and why it's calculated that way. Context is everything. Now, we've mostly talked about beta relative to the overall stock market index, like the S&P 500. Are there other contexts where this idea of beta is used to measure sensitivity to different things?
Yes, definitely. The sources briefly touch on how the core concept of beta measuring sensitivity to a factor can be applied more broadly. It's not just about sensitivity to the main stock market index.
Oh, what other kinds of betas might you encounter then?
Well, one important context is in more complex asset pricing models, like the arbitrage pricing theory or APT.
APT, how's that different from KPM?
Unlike the capital asset pricing model, CAPM, which is fundamentally a single factor model where the only systematic risk factor is the overall market.
Right, driven by the market beta.
Exactly. APT is a multi-factor model. It proposes that asset returns aren't just driven by the market, but by several different systematic risk factors simultaneously.
So instead of just sensitivity to the market, a stock's return might be explained by its sensitivity to, say, changes in interest rates and maybe changes in inflation expectations and maybe industrial production growth all at the same time.
That's the idea. In an APT framework, you would actually estimate multiple betas for each asset. One beta representing its sensitivity to the interest rate factor, another beta for its sensitivity to the inflation factor, maybe another for energy price changes, and so on. The Wikipedia source gives the specific example of potentially having an oil beta to measure a stock's specific sensitivity to movements in oil prices.
Ah, okay.
This really reinforces the idea that beta doesn't exclusively refer to market beta. It's a more general statistical term for a coefficient that measures the sensitivity of an asset's return to changes in a specific systematic risk factor, whatever that factor might be.
That makes a lot of sense. It's just the coefficient in a model trying to explain returns based on multiple potential drivers.
Exactly. The sources also make another practical point. The betas you sometimes see quoted in analyses of mutual funds or exchange-traded funds, ETFs, might actually be measuring the fund's exposure to a specific fund benchmark, which might not be the overall broad market like the S&P 500.
Oh, right. So if a fund specifically focuses on, say, small cap growth stocks, its reported beta might be measured against a small cap growth index, not the S&P 500.
Precisely. And that beta tells you how closely the fund's performance tracks its specific target benchmark. That's useful information, but it's different from understanding its beta relative to the overall market. It helps investors understand the risk profile of adding that specific fund to a portfolio that might already be diversified across that particular benchmark style.
Okay, good distinction. Any other interesting types of beta mentioned in the sources?
The Wikipedia source also briefly mentions something called volatility beta. This is a more advanced concept used particularly for assets whose relationship with their underlying driver isn't linear, think derivatives like options.
Right. Options pricing is definitely nonlinear. Their sensitivity changes a lot depending on the stock price, time left, etc.
Exactly. The standard linear beta calculation we discussed isn't really suitable for options because that relationship isn't constant. Volatility beta in this context often involves looking at the covariance between the derivative's return and changes in the underlying asset's value, but it requires adjustments to account for the sort of instantaneous nature of price changes and the impact of changing volatility itself. It's related to concepts like volatility risk, and the Greeks used in options trading, particularly Vega, which measures sensitivity to changes in implied volatility.
Okay, that's getting pretty technical, but it shows the beta concept adapts. So while market beta is definitely the most common application we encounter, the core idea of beta as a measure of relative sensitivity to some systematic factor is quite flexible and gets used in different, more specialized contexts, especially for more complex instruments or detailed risk modeling.
It's a versatile statistical tool for quantifying exposure to different kinds of systematic drivers. Absolutely.
Okay. We have spent a lot of time detailing what beta is, how it works, its applications, especially in portfolios. But, no single metric in finance is ever perfect. And the sources make it clear beta has some pretty well-documented limitations. What are the key areas where beta tends to fall short? Where should we be cautious?
This is a really critical part of any deep dive into beta. And yes, the sources provide a pretty comprehensive list of its drawbacks. Perhaps the single most significant limitation, the one everyone mentions, is that beta is heavily reliant on historical data.
Right. It's calculated using past price movements, like we discussed. Why is that such a big problem?
Because, as Investopedia points out quite bluntly, past performance, while maybe informative, is notoriously a poor predictor of future results, especially in markets that are constantly changing. Beta is inherently a rearview mirror.
Looking backwards.
Exactly. It tells you how a stock behaved relative to the market over some specific historical period, maybe the last 3 or 5 years. But that historical relationship, that correlation and relative volatility, might simply not hold true going forward. Market conditions change constantly. A company's own business model might evolve. Its competitive landscape can shift dramatically. Its financial leverage might change. None of these future changes are necessarily captured or predicted by a beta calculated purely on past data.
So using a beta calculated based on the last 5 years to predict how sensitive a stock will be to the market next year, that might be pretty inaccurate.
It absolutely could be. It's fundamentally backward-looking. Another major limitation, which Phoenix Strategy Group highlights, relates back to those underlying assumptions of the capital asset pricing model, CAPM, the very model where beta plays such a central role. CAPM relies on a set of assumptions that are, frankly, highly unrealistic in the real world.
Unrealistic how? What are some of those assumptions?
Well, CAPM assumes things like all investors are perfectly rational and risk-averse. They all have access to the same perfect information at the same time. They can borrow and lend unlimited amounts at a single risk-free rate. They pay no taxes or transaction costs. And they can perfectly diversify away all unsystematic risk instantly.
Yeah, okay. None of that sounds like the real world I invest in.
Exactly. As Phoenix Strategy Group notes, these conditions simply don't exist. Markets aren't perfectly efficient. Information isn't perfectly distributed. Investors are definitely not perfectly rational. Behavioral biases are a huge factor.
Sure.
Transactions have costs. Accessing a true risk-free rate for borrowing at scale isn't always possible for everyone. The list goes on.
So the theoretical framework that makes beta so central in academic finance has some pretty flawed foundations when you apply it to the messy real world. Yet the sources mention that a lot of CFOs still use it for calculating cost of capital.
They do. It's a bit of a paradox. Phoenix Strategy Group cites a survey suggesting a high percentage of CFOs, something like 73.5%, still use CAPM to estimate their company's cost of equity. Why? Often it's attributed to its relative simplicity compared to other models, and the fact that its core logic, higher systematic risk, requires higher expected return is intuitively appealing.
Okay.
But this widespread use doesn't negate the fact that the model's underlying assumptions are routinely violated in practice. And that violation can make beta estimates derived from it less reliable for critical real-world applications, like accurately setting the discount rate for major investment decisions.
Okay. So beyond the theoretical limitations of the model, are there also just practical challenges in calculating beta accurately, even using historical data?
Yes, absolutely. There are several practical calculation issues that can make the beta estimates you find noisy or potentially misleading. One big one is the choice of market index used as the benchmark.
Right. We talked about using the S&P 500, but you mentioned different sources might use different ones.
Exactly. If one source calculates beta using the S&P 500, which is mostly large-cap U.S. stocks, and another uses the Russell 2000, which is small-cap U.S. stocks, or maybe a sector-specific index or even a global index, they will likely get different beta values for the exact same stock. This makes comparing betas across different sources potentially tricky unless you know exactly which benchmark was used in each calculation. Furthermore, for international stocks, things like time zone differences or currency fluctuations can lead to what's called non-synchronous data. The trading times don't perfectly line up. This can distort the calculated correlations and potentially result in artificially low or inaccurate beta values.
Wow, that's a hidden complexity. The number itself depends heavily on those underlying data choices made by whoever calculated it.
Exactly. It's not always a universally agreed upon number. Another significant challenge, particularly for smaller companies or stocks that aren't traded very frequently, is the issue of low trading volume, infrequent trading.
Okay, how does low volume mess up the beta calculation?
When a stock doesn't trade very often, the last recorded price might be stale. It might not reflect the true up-to-the-minute market sentiment or value because no trades have happened recently. If you use these stale prices in the beta calculation, It can artificially flatten the apparent price movements of that stock relative to the constantly updating market index. This can lead to a calculated beta that underestimates the stock's true market sensitivity or risk. It looks less volatile than it really is simply because its price isn't updating frequently.
Right.
This is a common issue for less liquid stocks, especially smaller companies. Using longer return intervals, like weekly or monthly returns instead of daily, can help mitigate this non-synchronous trading issue somewhat. But the trade-off is that your beta estimate becomes less responsive. It reacts more slowly to recent market changes.
So if you're looking at the beta for a small cap stock, you should probably be particularly cautious about how reliable that number is.
You should definitely understand that its beta might be less reliable or at least calculated differently than the beta of a large, very frequently traded company like Apple or Microsoft due to these potential data issues.
Okay. Beyond the calculation problems, though, it feels like beta just misses a lot about the company itself, fundamentally.
It absolutely oversimplifies risk. That's a major criticism. Beta, by design, is laser-focused on measuring only systematic, market-related risk. It completely ignores the vast landscape of company-specific factors that can be huge drivers of both risk and potential return.
Like, what kind of factors does it miss?
Well, as Phoenix Strategy Group and Investopedia both point out, beta tells you absolutely nothing about crucial things like the quality and experience of a company's management team, the strength or weakness of its competitive advantages, its moat, the specific regulatory environment it operates within, how efficient its operations are, or what its future strategic direction looks like.
Right.
A company might have a low beta based purely on historical market correlation, suggesting low risk. But if, behind the scenes, its CEO is about to resign under a cloud, it's facing a major industry disruption, a new competitor is eating its lunch, or it's involved in a significant lawsuit, its true risk profile could be significantly higher than that low beta suggests. Beta doesn't capture any of that fundamental business risk.
And Investopedia made that interesting point about upside versus downside volatility.
Yes, that's a really insightful critique, often leveled at beta. Beta simply measures the magnitude of price swings relative to the market, regardless of whether those swings are up or down. But for most investors, a big swing up is generally seen as opportunity, not risk.
Yeah, I like those swings.
Exactly. A big swing down is the kind of risk they typically want to avoid or manage. Beta doesn't distinguish between these two very different types of volatility from an investor's perspective. It treats them both the same.
And it doesn't reflect fundamental changes in the business itself, you're saying?
No, don't inherently or immediately. Beta is based on statistical patterns observed in past price data, not on fundamental valuation or any deep analysis of the business's prospects. Investopedia gives a great example. Think about a traditional utility company. Usually a low beta, stable, predictable business.
Right, defensive stock.
But what if that utility company suddenly decides to take on a massive amount of new debt and invest heavily in a completely new, much riskier venture, like maybe unregulated energy trading? Its historical beta will still reflect its past life as a stable utility. But the fundamental risk of the business has just skyrocketed because of the new debt load and the shift into a riskier operating model. A beta calculated on that historical data wouldn't capture this massive shift in fundamental risk until much, much later, if ever, only after the new risk profile starts showing up in changed correlations of volatility patterns over time.
That seems like a pretty big blind spot if you're looking at a company that's undergoing significant strategic change or restructuring.
It absolutely is. This is why Phoenix Strategy Group specifically notes that traditional beta methods can be particularly problematic, potentially misleading when trying to assess the risks of rapidly growing companies. Their business models, their financial structures, their market positions are often constantly evolving. Their risk profile today might be vastly different from what it was just last year, even if their historical beta calculation looks stable on the surface.
Okay. And finally, how reliable is beta over time for just a single stock? Does it stay stable?
Not usually. No. Investopedia points out that an individual stock's beta tends to flip around or change quite significantly over time. It's not a static number. This makes it somewhat unreliable as a predictor of future market sensitivity, especially if you're a long-term investor trying to gauge risk over many years. It's generally considered a more useful tool, perhaps, for short-term traders who are focused on near-term volatility, or maybe for analyzing broadly diversified portfolios where the instability of the individual betas tends to average out somewhat at the portfolio level. And of course, the obvious point, very new stocks like recent IPOs, simply don't have enough price history to even calculate a statistically reliable beta in the first place.
Okay. So, wow. While beta is widely available and gives you that quick snapshot of market sensitivity, we really need to remember its significant limitations. It's based on the past, not the future. It relies on unrealistic theoretical assumptions. Its calculation can be distorted by benchmark choices or data issues like low volume. It completely ignores crucial company-specific factors and fundamental business changes. It doesn't distinguish between good volatility upside and bad volatility downside. It can be less reliable for dynamic growth companies. And it can be pretty unstable over time for individual stocks. That's quite the list of reasons to maybe look beyond just this single number when assessing risk.
It is indeed. It's a valuable starting point, maybe a first filter for understanding systematic risk, but it is far, far from the final word on an investment's overall risk profile. Which naturally brings us to the next question. What else do people use? What are the methods finance professionals employ to try and get a more comprehensive, more robust picture of risk, moving beyond simple beta?
Yeah, exactly. If simple historical beta has all these shortcomings we just detailed, what are some of the more sophisticated approaches or metrics that finance pros use to assess risk more effectively? How do they try to overcome these limitations?
Okay, the sources detail several important methods that aim to go beyond the limitations of simple beta and that single-factor CAPM world. One key area is the development and use of multi-factor models.
Multi-factor models. Okay, so models that basically say a stock's return isn't just explained by the overall market movement, but by other identifiable factors too.
Exactly. These models propose that asset returns are systematically influenced by exposure to multiple distinct risk factors, not just the single market risk factor captured by beta in CAPM. The most prominent examples you hear about are the Foma-French models.
Foma-French.
The original Foma-French three-factor model, for instance, expands on CAPM by adding two additional factors alongside the market risk premium. These are the size premium, often denoted SMB for small minus big, and the value premium, often denoted HML for high minus low book to market.
Size premium and value premium.
Yeah.
What do those capture intuitively? What's the idea behind them?
Well, the size premium, SMB, aims to capture the historical tendency observed over long periods for small capitalization stocks to outperform large capitalization stocks, on average, even after you account for their market beta.
Okay, small stocks tend to do better.
Historically, yeah. And the value premium, HML, aims to capture the historical tendency for so-called value stocks, typically defined as those with high book value of equity to market value of equity ratios to outperform growth stocks, those with low book-to-market ratios.
Right, the value investing effect.
Exactly. By including an asset sensitivity to these additional factors, which are measured by their own specific betas relative to those factors, the three-factor model can explain a significantly larger portion of the variation we see in diversified portfolio returns compared to the simple CAPM. Phoenix Strategy Group quotes figures suggesting the three-factor model explains roughly 90% of diversified portfolio returns versus CAPM's approximately 70%.
Wow, that's a pretty significant jump in explanatory power. It strongly suggests that size and value characteristics are also systematic drivers of both risk and return beyond just overall market exposure.
That's how they are treated within this modeling framework, yes. And Vama and French didn't stop there. They later expanded this into a five-factor model, adding two more factors related to profitability. More profitable companies tend to do better, and investment patterns. Companies that invest more conservatively tend to have higher expected returns.
Okay, getting even more complex. And the Carhart model that was mentioned, what did that add?
The Carhart four-factor model took the Fama-French three-factor model, market size, value, and added one more factor, momentum, often denoted WML for winners minus losers.
Momentum. The idea that stocks that have been going up tend to keep going up, and vice versa for a while.
That's the empirical observation it tries to capture, yes, that stocks that have performed well recently tend to continue performing well in the short to medium term, and those that perform poorly tend to continue lagging. Adding this momentum factor can, according to some studies cited, further increase the explanatory power of the model, maybe reaching around 95% for diversified portfolio returns.
Okay, so these multi-factor models clearly give a much more granular, more nuanced view of where risk and return might be coming from. It's not just the market tide lifting all boats or sinking them, but also these other currents related to size, value, profitability, investment, momentum.
Yes, exactly. Phoenix Strategy Group uses a good example to illustrate this. Think about a small biotech firm versus a large established utility company. They might, just by chance, have similar betas relative to the overall market index, say both are around 1.0, but their multi-factor betas, their exposures to these other factors, would likely look vastly different. The biotech firm might have a high positive exposure to the size factor because it's small cap, and maybe high exposure to value or growth factors depending on its specific stage and prospects. The utility, on the other hand, would likely have low or negative exposure to the size factor, being large cap, and possibly different exposures to factors sensitive to economic cycles or interest rates. These models provide a much more nuanced understanding of their truly distinct risk profiles, which a single market beta number completely misses.
That makes a lot of sense. Okay, so more complex quantitative models exist to get beyond simple beta, but models are still, abstract representations. What about combining the numbers, whether simple beta or multi-factor betas, with actual real-world insights into the specific business?
That is the other critical approach that the sources really emphasize: the importance of integrating quantitative analysis with qualitative company-specific analysis.
So looking at the statistical risk measures the models give you, but also really looking under the hood of the company itself, understanding its story, its management, its industry.
Precisely. Quantitative models, whether simple or complex, are great at identifying statistical patterns based on historical data. They can highlight correlations, volatilities, factor exposures, but they generally can't capture unique, forward-looking risks or opportunities or specific situations that might not have clear precedents in the past, data used to build the model.
Like those things we mentioned earlier, management changes, new regulations coming down the pike, a disruptive technology emerging.
Exactly. Phoenix Strategy Group stresses this point heavily. Qualitative factors like the quality, experience, and stability of the management team, the strength and sustainability of a company's competitive advantages, its moat, the specific regulatory landscape it has to navigate, how efficient its operations are compared to peers, and what its overall strategic direction and execution capabilities look like. These are huge drivers of actual investment risk and return that are basically invisible to standard beta calculations.
Right.
A company might look statistically low risk based on its historical beta, but if you do the qualitative work and discover it relies almost entirely on a single key supplier that's known to be financially shaky, or its core product is facing imminent obsolescence due to a technological shift, beta isn't going to flag that risk for you.
So combining the two approaches, the quantitative and the qualitative, gives you a much more complete, robust picture of risk.
It aims to, yes. The quantitative models provide a valuable data-driven baseline. They highlight the market-related risks and maybe other factor exposures. The qualitative analysis provides a central context. It helps identify those unique, company-specific risks and opportunities that don't necessarily show up in broad historical data patterns. Things like potential cybersecurity vulnerabilities, specific supply chain concentration risks, or pending legal challenges. And, importantly, qualitative analysis allows analysts to adjust their overall risk assessment based on anticipated future changes or developments, not just react to past behavior.
Right.
Forward-looking. Exactly. This integrated approach ideally offers both a broad systematic view and detailed company-specific insights. And crucially, it's not a one-time thing. It requires continuous monitoring and updating as both market conditions and company specifics evolve.
Okay. Now, are there also ways to just get a better estimate of historical beta itself? Maybe methods that try to account for some of those calculation issues we discussed earlier, like the data problems or the fact that betas seem to change over time?
Yes, definitely. The Wikipedia source describes several techniques that statisticians and quantitative analysts, quants, have developed over the years. These are essentially improved beta estimators that try to produce more statistically reliable or stable beta figures from the available historical data. They often attempt to address specific known issues like measurement error in the data, the phenomenon of regression toward the mean, or the non-synchronous trading problem we mentioned.
Regression toward the mean. Remind me what that is again.
That's the common statistical observation, that extreme values, whether extremely high or extremely low, tend to move back closer towards the average or mean value over time. So if a stock has an exceptionally high historical beta, say 2.5, or an exceptionally low one, say 0.2, there's a statistical tendency for its future beta to drift closer back towards the overall market average beta, which is 1.0. Some estimation techniques try to explicitly account for this expected drift.
Okay, like the Bloom beta that was mentioned. Does that do it?
Yes. The Bloom beta is probably the most widely known example of an adjustment for regression toward the mean. It essentially shrinks the raw historical ordinary least squares. OLS beta. That's the one you get from the simple linear regression we talked about towards the market average of 1. A common formula used is a weighted average, maybe 23 OLS beta plus 13 1.
Okay, it pulls extreme beta as closer to 1.
Right. It's relatively simple and has been used by some financial data providers. However, the source notes that despite its widespread historical use, empirical studies suggest it actually performs relatively poorly at predicting future beta compared to some more sophisticated statistical methods.
Huh. Interesting that a widely used method isn't necessarily the most effective predictor. What are some of those other, maybe better estimators?
Well, there's the Vasicek beta. It also shrinks the OLS beta towards 1, but it does so in a more statistically nuanced way. The amount of shrinkage depends on the statistical precision, the standard error, of the initial OLS beta estimate, and also on the overall variation or heterogeneity of betas across the entire market. It's considered a theoretical improvement over both OLS and the simple Bloom adjustment, but it is more complex to calculate.
Okay. And what about those estimators specifically designed for stocks that aren't traded all the time, the infrequent trading issue?
Right. Those are the Scholes-Williams beta and the Dimson beta estimators. They were specifically developed to try and correct for the bias introduced by non-synchronous trading. That problem where the times a specific stock trades don't perfectly align with the times the market index price is recorded or calculated. This issue is particularly relevant in markets with less frequent trading, maybe emerging markets, or for assets like private equity, where valuations are infrequent.
But maybe less critical for actively traded U.S. stocks.
Generally, yes. For large, liquid U.S. stocks with readily available daily closing prices, these particular methods are often considered less critical than some of the others focused on stability or prediction.
Okay. Methods tailored to specific data limitations.
Got it.
And finally, the source mentions one called the Welch beta. This sounds like a more modern approach. It involves using slope-Winsorized daily returns, which basically means adjusting or capping extreme daily price movements to make them less influential on the calculation, and then employ the technique called weighted least squares, WLS estimation. The source claims that empirical tests suggest this Welch beta method outperforms OLS, Bloom, Vasicek, and Dimson betas, specifically when it comes to forecasting future beta and for use in developing effective hedging strategies.
That sounds like a potentially promising, more robust statistical approach then. So these are all various techniques trying to get a more reliable historical estimate of beta, sometimes explicitly trying to build in a prediction about the future based on that history, like the regression to the mean idea. Exactly. Most of these methods are trying to estimate the instantaneous or currently prevailing beta more accurately from the noisy historical data. The separate issue of how beta might behave over the very long term, its tendency to revert towards 1, is often considered a subsequent adjustment or consideration on top of getting the best possible current estimate.
Okay. Now, we noted earlier that traditional beta, even if calculated well, can be particularly problematic for those rapidly evolving growth companies because their risk profiles change so fast. Are there specific adjustments or approaches tailored just for them?
Yes, Phoenix Strategy Group specifically highlights that growth companies require particular attention and often tailored approaches because their risk profiles can indeed change very quickly. One absolutely crucial adjustment is related to leverage adjustments.
Right, because their debt levels can change a lot as they grow.
Exactly. As a company grows, its funding needs change. It might take on more debt or issue more equity, so its debt-to-equity ratio can fluctuate dramatically. Since the standard levered beta includes the effect of that debt, simply using an old beta calculation becomes quickly outdated. Recalculating the levered beta based on the company's current or very recent capital structure is essential.
That Carnival Core example you mentioned earlier really illustrates this, right? Their beta apparently jumped significantly because they took on a lot more debt after the COVID pandemic hit their business.
It's a perfect real-world example. It shows that relying on a pre-pandemic beta calculation for Carnival, when its debt load had fundamentally changed, would give a completely misleading picture of its current market risk sensitivity. For companies undergoing significant changes like that, regular, perhaps even annual recalibrations of beta based on their up-to-date capital structure are absolutely vital. Another technique particularly useful for growth companies is rolling beta analysis.
Rolling beta. That means recalculating beta frequently using only a recent window of data, like the last year or two.
Exactly. Instead of using a long, static period like 5 years, you use a shorter, moving window, say 2 years, maybe 24 months, of daily or weekly data. As each new month or week of data comes in, You drop the oldest month or week and recalculate beta based on the most recent 2-year period.
How does that help?
It allows analysts to constantly update the beta estimate and see how the stock's sensitivity to the market is actually shifting over time as the company evolves and as market conditions themselves change. A 2-year window is often suggested as a reasonable balance, that you have enough data points for some statistical reliability, but the window is recent enough to be relevant for a fast-changing company. And importantly, Phoenix Strategy Group also emphasizes the potential value of trying to estimate a forward-looking beta for growth companies.
Forward-looking beta, how is that different from all these historical calculations? How can beta look forward?
Well, instead of relying purely on past price movements, the idea behind forward-looking beta is to try and capture current market conditions and, crucially, anticipated future risks by incorporating information embedded in other real-time market data, particularly options prices.
Options prices, how do they help?
The prices of traded options on a stock contain information about the market's collective expectation of that stock's future volatility. This is known as implied volatility.
Right, implied volatility.
By extracting this forward-looking implied volatility from options prices and potentially combining it with historical correlations, which tend to be a bit more stable than historical volatilities, analysts can attempt to construct a beta estimate that is arguably more relevant to the market's current view of the stock's future risk, rather than relying solely on a number generated from purely historical price patterns.
That sounds like a significant conceptual step towards making beta more predictive and potentially more relevant for these dynamic companies whose past isn't necessarily a great guide to their future.
It is, conceptually. It's an attempt to incorporate current market sentiment and expectations directly into the risk assessment. Finally, the sources highlight the growing importance of something called data engineering in improving all kinds of risk assessment, including beta calculations.
Data engineering. That sounds very tech-focused, like IT infrastructure.
It is quite tech-focused, yes. But it's critical for finance now. It involves building sophisticated data pipeline systems to automatically collect, clean, process, and analyze vast amounts of financial data efficiently and accurately. This includes implementing automated systems to handle common data quality issues we discussed, like outliers, missing data points, or corporate actions, like stock splits or mergers, that can distort historical calculations if not handled correctly.
So basically automating the tedious data cleanup process that needs to happen before you can even calculate a reliable beta.
Exactly. It ensures the input data feeding into the calculations is as consistent and reliable as possible. But it goes further. Advanced data engineering, often combined with machine learning techniques, can also help analysts identify complex patterns or, importantly, detect structural breaks in the historical data relationships.
Structural breaks, what are those?
These are sudden, significant shifts in the underlying statistical relationship between variables. For example, maybe the historical correlation between a specific stock and the overall market suddenly breaks down completely, or its volatility regime fundamentally changes due to some major event.
Okay.
Phoenix Strategy Group uses the powerful example of PG&E, the California utility. During the periods of major California forest fires linked to their equipment, PG&E's beta and its correlation with the market apparently plunged dramatically, while its own individual volatility spiked enormously. A traditional historical beta calculation might just average right through such a dramatic company-specific event. But advanced data monitoring systems might be able to detect this kind of structural break in near real time.
And flag that the old historical beta is probably no longer representative of the current reality.
Precisely. It could flag that the historical relationship beta relies on has fundamentally changed, prompting a necessary reassessment of the company's risk profile using maybe more qualitative or forward-looking information. Real-time data processing and automated monitoring can provide crucial alerts to these kinds of significant shifts. And underlying all of this, good data governance, having clear protocols for data quality validation procedures, thorough documentation, is essential to build trust in these increasingly complex, data-driven risk assessments. The rapid growth of AI in finance that the source mentions really underscores this trend towards more sophisticated tools.
Wow, okay. So it's clear that while simple historical beta is the number we most often see and it's easily accessible, The world of professional finance is leveraging much more sophisticated tools. They're using multi-factor models. They're insisting on combining quantitative metrics with deep qualitative insights. They're employing improved statistical estimators to get better historical numbers. They're applying specific adjustments for things like changing leverage or the unique needs of growth companies. And they're increasingly employing advanced data engineering and even AI to get a much more nuanced, robust, and dynamic picture of investment risk than simple beta alone can provide.
That's a very accurate summary of the landscape described in the sources. They're definitely moving beyond relying solely on a single, often backward-looking metric towards using more integrated, sometimes forward-looking, and certainly more data-intensive approaches to understand risk.
Okay, let's just step back for a moment and make sure we clearly understand the relationships between beta, standard deviation, and alpha. We've mentioned all three concepts at different points. How do they fit together, and where do they differ fundamentally?
That's a great clarification point. These are, indeed, three absolutely fundamental metrics used in finance for evaluating investments. And while they are related in the context of risk and return, they measure distinct and different aspects. Let's start with standard deviation. As we touched on earlier, standard deviation is a measure of total risk.
Total risk meaning both the systematic market risk and the idiosyncratic company-specific risk all bundled together.
Yes, exactly. It quantifies the overall volatility or dispersion of an asset's returns around its average. How much does it tend to bounce around? Period. The Reddit discussion source points out quite correctly that standard deviation is the most relevant measure of risk if you are holding a non-diversified portfolio, for example, if you own just one stock or maybe only a handful of stocks.
Right, because then you are exposed to everything.
Exactly. In that case, you are exposed to the full spectrum of risks associated with those specific holdings, both the market-wide movements and all the unique risks specific to those few companies. Standard deviation captures that total combined variability.
Okay. And beta, again.
Beta, in sharp contrast, is designed to measure only the systematic risk component. As the sources consistently emphasize, beta is considered the relevant risk measure when you are looking at an investment's contribution to the risk of a well-diversified portfolio.
Because in that diversified context, the idiosyncratic risk, the company-specific stuff, has theoretically been averaged away, diversified out.
Precisely. That's the core argument from capital market theory, echoed in the sources. The idea is that rational investors holding broadly diversified portfolios are primarily concerned with systematic risk, because that's the risk they can't eliminate through further diversification within the market. Theory suggests they aren't compensated for taking on idiosyncratic risk, because they could theoretically get rid of it themselves just by diversifying more. So beta tells them how much of that non-diversifiable systematic risk a particular asset is adding to their already diversified mix.
Okay, so standard deviation for total risk, most relevant for concentrated or undiversified portfolios. Beta for systematic risk, only most relevant for well-diversified portfolios or analyzing contribution to one. Now, there was that debate mentioned in the Reddit thread about which one is better for actual stock picking. How did that play out?
Yes, that discussion really highlights the nuance here and how the right risk measure can depend on your perspective or objective. One perspective presented is that if you are actively engaging in stock picking and deliberately building a concentrated portfolio based on your unique insights about specific companies.
Right, you believe you know something others don't about those few stocks.
Exactly. Then you are intentionally taking on significant idiosyncratic risk. Beta, by definition, doesn't tell you anything about that company's specific risk or your potential reward for bearing it. Therefore, from this viewpoint, measures related to total risk, like standard deviation, and specifically measures evaluating how much idiosyncratic risk contributes to generating excess return, which is where alpha comes in, might be more relevant for evaluating the skill or success of that concentrated stock picker. Metrics like the information ratio, which is basically alpha divided by idiosyncratic risk tracking error, are often used for this.
Okay, so if I'm picking just 5 stocks that I think are amazing, maybe I care more about their individual standard deviations, their total volatility, and their potential to generate alpha based on their unique company's specifics, rather than just focusing on their beta relative to the overall market.
That's certainly one coherent view presented in the discussion. The other view, again, rooted more firmly in traditional CEPM and portfolio theory, maintains that even if you are actively stock picking, if your ultimate goal is to build wealth efficiently over the long term, you should ideally think of your individual stock picks as just parts of a potentially diversified global investment portfolio, even if you don't literally hold the entire global market yourself. From this perspective, the theory states that only systematic risk, as measured by beta, is reliably compensated by the market with higher expected returns. Therefore, beta remains the relevant risk measure for assessing how any stock, even one you pick for specific reasons, contributes to your overall portfolio's systematic risk exposure, regardless of how concentrated your personal portfolio might happen to be in that particular stock at the moment.
Hmm. It sounds like the debate really boils down to your fundamental investment philosophy, whether you believe you can consistently profit from taking on idiosyncratic risk, or whether you believe it's more efficient to primarily focus on managing your exposure to compensated systematic risks through diversification.
It largely does, yes. Standard deviation captures the total variability of the ride. Beta captures only the market-related component of that ride.
Okay. And where does alpha fit neatly into this picture? We briefly mentioned it earlier in the context of that regression equation as the part beta doesn't explain.
Right. Alpha Elvis is formally defined as the measure of an investment's performance that is independent of the market movements, as captured by beta in the simple CAPM framework, or potentially independent of multiple factors in the more complex multi-factor models. Investopedia defines alpha clearly as measuring the performance component attributable to factors other than the tracked systematic risks, things like manager skill, unique factors specific to that asset, perhaps exploiting temporary market inefficiencies rather than just performance gain from riding broad market trends, which is captured by beta.
Okay, so if a stock, or maybe a mutual fund, generates returns that are higher than what you would have expected based only on its measured beta exposure to the market, or its exposure to multiple factors, that excess unexplained return is the alpha.
Exactly. A positive alpha suggests that the stock, or more often the fund manager managing a portfolio of stocks, added value beyond what simply taking on that level of systematic market risk would have justified according to the model. Beta focuses on quantifying the systematic risk you took on. Alpha focuses on the incremental return achieved, or lost if alpha is negative, after accounting for that systematic risk exposure.
Are alpha and beta typically correlated? Like, do high beta stocks tend to have high alpha?
The Investopedia FAQs section specifically addresses this. It notes that alpha and beta are not directly correlated in a statistical sense. A stock can have high beta and positive alpha, high beta and negative alpha, low beta and positive alpha, or low beta and negative alpha. However, there can be indirect relationships depending on the specific investment strategies being employed or the prevailing market conditions. But for investors, the ideal combination, the holy grail, as you called it earlier, is often considered finding assets that exhibit high alpha and low beta.
Right, that combination of potential for outperformance, high alpha, combined with relative stability or low sensitivity to overall market downturns, low beta. That does sound like the dream.
It certainly is the goal for many active managers. So just to summarize the triad, standard deviation measures total risk, most relevant for concentrated portfolios. Beta measures systematic risk only, most relevant for diversified portfolios or contribution to them. And alpha measures the performance component that is not explained by those systematic risk factors, often attributed to unique asset characteristics or active management skill. They are distinct but interconnected metrics, all crucial for evaluating different facets of an investment's characteristics.
That's a really helpful summary. Thanks. Okay, so given everything we've discussed about beta now, what it is, what the numbers mean, how it's calculated and miscalculated sometimes, its key role in diversification, but also its significant limitations, how is beta actually used in practice by investors? Are there specific investment strategies that directly incorporate beta into their process?
Yes, absolutely. Investopedia mentions several common ways that investors and professional fund managers put the concept of beta to work when they are constructing and managing portfolios.
Okay. Like strategies based simply on choosing stocks that have certain beta levels. Is it that straightforward sometimes?
That's certainly the most straightforward application, yes. You have what are sometimes called high beta strategies. These involve intentionally selecting and overweighting stocks that have a beta significantly greater than 1.0. The primary goal here is usually to maximize potential returns during periods when the investor believes the overall market is likely to rise strongly, a bull market. Of course, the trade-off is accepting the higher likelihood of amplified losses if the market prediction is wrong or if the market simply declines.
Okay. And I assume low beta strategies would be the mirror image.
Exactly. These strategies prioritize investing in stocks with a beta significantly less than 1.0, often focusing on those defensive sectors we talked about, like utilities, consumer staples, healthcare. The primary objective here is usually seeking stability, capital preservation, and downside protection. which might be particularly valued in uncertain market environments or during expected economic recessions. These approaches generally accept that they will likely capture less of the upside compared to high beta strategies during strong market rallies.
Makes sense. What about strategies that try to get rid of beta exposure entirely, neutralize it?
Yes, those generally fall under the umbrella of market-neutral strategies. These tend to be more sophisticated approaches, often used by hedge funds. They aim to construct a portfolio by carefully balancing long positions, bets that stocks will go up, and short positions, bets that stocks will go down, in different assets, such that the portfolio's overall weighted average beta is close to zero.
Why way to do that?
The intention is to generate returns primarily from the relative performance of the specific asset selected, stock picking skill, or alpha, rather than relying on, or being exposed to, the overall direction of the market, the beta. They're trying to isolate alpha.
That sounds quite complex to implement and manage correctly.
It definitely can be. Another strategy mentioned is beta rotation. This involves actively shifting the portfolio's allocation between high beta assets and low beta assets based on an investor's or manager's forecast of the market's likely future direction. If they become bullish and anticipate a rising market, they would increase the portfolio's exposure to high beta stocks. Conversely, if they become bearish and anticipate a falling market, they would shift towards low beta stocks or even cash.
But as we discussed, that relies heavily on successful market timing.
Which is famously difficult to do consistently, yes, a high hurdle. Finally, the sources mention the category of smart beta strategies.
Smart beta, I hear that term a lot. What does it mean in this context?
Smart beta strategies are essentially rules-based investment strategies that intentionally deviate from the traditional market capitalization weighting used by standard index funds, which passively accept the market's beta of 1. Instead of just targeting market beta, smart beta strategies specifically aim to target exposure to other systematic risk factors or investment styles that have historically shown some potential for delivering better risk-adjusted returns over time.
Like the Fama French factors we discussed. Size, value.
Exactly. Common smart beta strategies might target factors like value, momentum, quality, profitability, low debt, low volatility, which is closely related to low beta, or size, small cap. The idea is to tilt the portfolio towards these factors using a rules-based, often transparent methodology.
So instead of just passively tracking a standard beta 1 index, you're using beta, or perhaps these other factor betas, in a more active way to deliberately build a portfolio that's skewed towards certain characteristics you believe will pay off.
That's a good way to put it, yes. So you can see beta is not just a descriptive statistic after the fact. It can be, and is, used as an active tool in portfolio construction, in risk management, like hedging, and in the implementation of various investment strategies, whether you're seeking to maximize market exposure, minimize it, hedge it away entirely, or even target other related risk factors. It remains a pretty fundamental concept influencing many different approaches to investing.
Wow, okay. We have really taken a comprehensive deep dive into beta today. It feels like we've covered a lot of ground. We started right at the beginning, defining beta as that core statistic measuring a stock's sensitivity, its responsiveness to overall market movements. And we clarified that crucial point. It focuses specifically on systematic risk. The market risk, you can't just diversify away within the market and pointedly not the company-specific idiosyncratic risk.
We definitely explored how to interpret those all-important beta numbers. We looked at the benchmark, market beta 1.0, the amplified swings you expect from high beta stocks greater than 1.0, the relative stability associated with low beta stocks, less than 1.0 but still positive, the sort of uncorrelated nature of a zero beta, and even touched on the rare inverse movement implied by negative beta assets. We saw how beta is mathematically tied to concepts like volatility and correlation, and how its value is typically calculated using covariance and variance, or often estimated via linear regression using historical data. And importantly, we covered where you can usually find these beta numbers published online or on brokerage platforms.
And we really dug into its application in portfolios, understanding that the overall portfolio beta is that weighted average of the individual betas of your holdings, and it represents the aggregate market risk exposure of your entire collection of investments. We also took care to clarify that important distinction between the standard levered beta, which includes the impact of company debt and is what you usually see quoted for stocks, and the more technical unlevered beta, which strips out the debt effect and is crucial for comparing underlying business risk and for valuation work.
But just as importantly, maybe even more so for practical use, we spent significant time exploring the crucial limitations and caveats surrounding beta. We really stressed that it's fundamentally a backward-looking metric calculated based on historical data, and therefore not necessarily a reliable predictor of future risk or behavior. We highlighted how the somewhat unrealistic assumptions underlying the basic KPM model can weaken its theoretical foundation when applied in real-world markets. We also discussed the very practical challenges that can arise in its calculation, such as the significant impact of choosing different market benchmarks or the distortions caused by low trading volume in certain stocks.
Yeah, and we emphasized how beta, by its very nature, oversimplifies risk because it completely ignores those vital company-specific qualitative factors, management, competition, strategy, and it often fails to capture sudden changes in a company's fundamental business risk profile. We noted its potential unreliability, especially for rapidly changing growth companies, and the fact that even for stable companies, beta for individual stocks can be surprisingly unstable over time.
And then, to address those significant limitations, we looked at how finance professionals and sophisticated investors try to go beyond just relying on simple beta. We discussed the use of multi-factor models like the Fama, French, and Carhart models, which incorporate additional systematic risk factors beyond just the market. We stressed the absolutely essential practice of combining quantitative metrics, like beta, with deep qualitative company-specific analysis to get a more complete and forward-looking picture of risk. We touched upon those improved statistical estimators designed to wring better, more reliable beta numbers out of noisy historical data, and the specific adjustments often needed when analyzing growth companies, including that intriguing idea of trying to estimate a forward-looking beta using options data. And finally, we explored the increasing role that sophisticated data engineering and even AI are playing in handling complex financial data and potentially identifying major structural shifts in risk relationships that historical beta might miss.
We also made sure to clarify the distinct roles of beta, systematic risk, versus standard deviation, total risk, and how both relate to the concept of alpha, performance beyond what systematic risk exposure would predict, highlighting for whom or for which purpose each of these different risk measures is likely most relevant.
And lastly, we briefly touched on how beta is actively put into practice through various investment strategies, whether it's deliberately targeting high or low beta stocks, attempting to achieve market neutrality by eliminating beta exposure, trying to time shifts via beta rotation, or using beta and other factors as core components in the increasingly popular smart beta approaches.
Okay, so after all of that, covering the good, the bad, and the complex, what's the core takeaway? If you had to boil it down, what's the key lesson from this deep dive into beta?
I think the key takeaway is this. Beta is a fundamental, quantifiable, and often readily available tool. It provides a necessary, often useful, starting point for understanding and quantifying systematic risk, that unavoidable portion of investment volatility tied to overall market movements that remains even after you've diversified your portfolio reasonably well. It's a quick way to get a first-pass sense of a stock's or a portfolio's relative sensitivity to the market's inevitable mood swings.
But there's always a but, isn't there?
There is, but, and this is absolutely crucial for anyone using beta in their decision-making, it is only one tool in the risk assessment toolbox, and it's a tool with significant limitations. It's primarily a rear-view mirror, looking at the past. It ignores the unique story, the changing fundamentals, and the specific prospects of an individual company. Its calculation can be noisy and depend on methodological choices, and its reliability can vary significantly depending on the company, the market environment, and the time horizon. So for a truly robust, well-rounded understanding of investment risk, particularly if you're investing for the long term, or analyzing dynamic businesses, or trying to build genuinely resilient portfolios, you absolutely must look at beta alongside other metrics. You need to incorporate qualitative insights about the business and its environment. And potentially, you should consider utilizing more advanced models or data techniques if appropriate. Beta is foundational, yes, but it is decidedly insufficient on its own.
That distinction between beta as a useful starting point, maybe a flag, but definitely not the end point of risk analysis, that seems really important to internalize.
Absolutely set.
Okay, so let's leave you, our listener, with this final thought to consider. Given beta's inherent reliance on history, given the known flaws in the simple CAPM assumptions that underpin its traditional interpretation, and given the clear proliferation of much more sophisticated multi-factor models, advanced data analytics, and deep qualitative analysis in professional finance today, how much weight should an individual investor really place on that single, simple historical beta number they find readily available on a free financial website when making a significant long-term investment decision? Does beta's appealing simplicity perhaps make it potentially misleading if relied upon too heavily? Or is it still, despite all its flaws, a fundamentally valuable first filter for quickly understanding a key dimension of risk, that raw market sensitivity, something to chew on as you evaluate your next investment idea?
That's a very timely and practical question, especially as the data and the models available continue to become increasingly complex.
Indeed, it is. Well, thank you for joining us on this extensive deep dive into the world of beta. We certainly covered a significant amount of ground today, exploring its core concepts, its practical applications, and digging deep into its many nuances and limitations, all based on the source material provided. We sincerely hope this discussion has given you a much clearer, more complete, and more critical picture of how beta works, and perhaps more importantly, its proper place in the broader world of finance and investing.
Keep learning, keep asking those critical questions, and we'll catch you on the next deep dive.